This is level 2 of the CFA program, topic 4, financial reporting and analysis, and the reading on employee compensation. I'm guessing that you noticed that this is a super long reading, and so you shouldn't be surprised that we have prepared a super long slide deck. I will begin by offering my thoughts about this particular reading. It is written by two academics, both of whom have PhDs. One holds the CFA designation and the other is a certified public accountant. And so you kind of get the best of both worlds here. You get the accounting perspective and you get the financial analyst perspective. This is a super well-written chapter, lots of breadth and lots of depth in there, and you'll see that as we look through the learning outcome statements. As you read through these, you'll notice that the word pension is in many of them, and so we're going to have to do lots of description and lots of explanation. Notice that there is some calculations in here, so we have a handful of tables. So make sure you have your financial calculator handy, and then we'll end with a discussion on disclosures and some stock options and other share-based compensation. So let's start with a little bit of what we should remember from level 1. Post-employment benefits. All right, so pension, I already mentioned that. We can have health care, we can have medical insurance, or some other kind of additional health insurance. We can also have the stock options and stock grants. This is generally known as share-based compensations. And in order to value these, or in order to place some type of a present value on these benefits on the financial statements, we need to make some kind of assumptions. And so this is going to be super important as we go through these LOSs. So let's start with one that probably is not going to show up too much on the exam. Defined contribution plans. This is what I have as an employee of a college. And what happens is that twice a month I make a contribution out of my salary, and the college makes a contribution in relation to my salary. And so notice the employee's contributions are defined. That's why it's called a defined contribution plan. But I'm guessing you remember all this from level 1. The most likely question that would show up on the exam is that third teardrop point. The employee bears the investment risk inherent to the plan assets. I don't have tons and tons of choices, but I do have lots of pretty good choices. But one choice that's not in there, and this is probably a good idea, right? The employee bears the investment risk. So I could say, twice a month I could say, hey, what I want you to do is I want you to take my contribution. I want you to invest it in the roulette fund. And the manager of the roulette fund takes my money and goes to Las Vegas and, let's say, bets it on the red in the middle of the month and bets it on the black at the end of the month. And then when I retire, the roulette fund manager will probably look at me and say, there's nothing in here, Jim. Sorry. So the employee bears the investment risk. And of course, the benefits when I retire depend on two things, primarily the performance of the assets, right? So, of course, I have some kind of a well-diversified equity and fixed income security in mind. I don't have the roulette fund, and it also depends on my contributions. Now, another, slightly likely question on the exam is, where does this show up on the financial statements? And so that first teardrop point explains it all. Pension expense is reported on the income statement. Of course, as soon as the college sends that payment to my pension fund manager, that's reported as a pension expense. And, our year ends on the end of the month, and so there's probably no accruals. But of course, this is a not-for-profit, but you might have this type of a fund, and there might be some differences in the timing. So there's probably some accruals, but not. I wouldn't think they would be substantial. So let's switch over to what we'll talk about for the next, 6 hours, it might seem like on the slide deck. So defined benefit plan. The employer promises to pay a defined pension in the future. And of course, this is sometime after retirement. Now, those of you who have been watching my recordings over the years will note that I love giving history lessons here. And so the question then becomes, why is it that our pension plan is tied to our employer? This goes all the way back to sometime in 1942 when there were wage controls. So employers started to be creative and say, hey, you know what? We can only pay you this amount, but if you come work for us, we'll help you when you retire. So these defined pension plans, of course, depend on lots and lots of these actuarial assumptions. Employee compensation, average retirement age, life expectancy, all these kinds of things. And then, of course, these are future obligations. And remember, this is a legal and binding contract, right? I promise to pay you X amount of dollars when you retire. So this is enforceable in the court of law. And what the accountants have decided is that, you know what, you better not wait until Jim retires and say, okay, where's all this money going to come from that we owe him? We should pre-fund these plans. Which means then that the employer bears the investment risk. So that sounds like a really good exam question. Compare the DC and the DB plans. And of course, there are lots and lots of differences, but the primary difference is who bears that investment risk. So look at that last circle point. The employer must ensure that the plan assets are sufficient to cover the ultimate benefits promised to the employer. Promised to the employee. And there's a good quick example over there on the right-hand side. You can look through that as we switch to the next slide, which is really just a copy and paste from the Ford Motor Company. Note we go back to the end of the 20-teens, and these are in billions of dollars. So notice the pension fund status. Notice there are parentheses around these numbers. 2 billion, 3 billion, 6 billion. You probably shouldn't be surprised. Those of you who are regular readers of the Wall Street Journal will note that there are always articles that in there that say, hey, you know what? Here's another defined benefit plan that has a deficit. Interesting row there about the weighted average discount rates. Notice that they changed fairly substantially from 2018 to 2019. And we have a really good example about changes in that discount rate later on in the slide deck. All right, how about the LOS? Describe the types of post-employment benefits. All right, so other ones other than the pension, life insurance and health insurance. These are not pre-funded, so notice that we put that in red there. That's probably a good exam question. Notice that they are even more complex than what we're going to describe today because you have to think about things like, my gosh, healthcare costs. What do we know? I mean, nobody gets a letter from their employer saying, hey, guess what? Healthcare costs are going to rise by 0.1% or they're going to fall by 10%, right? So we need to worry about inflation in the healthcare industry and how does that impact us over, pretty much an extended long time period, especially during retirement, if you think about this, and those probably the time period when the retired employees are going to use the healthcare system probably more regularly than a 25-year-old. Expenses are reported when earned. Employer's cash flow unaffected until the benefits are paid to the employee. All right, let's get back to our focus here. Pension obligations. If you take a look at the reading, there's a really good quote in there about taken right from IFRS and US GAAP about present value. And so this is important that both of these accounting bodies define the pension obligation as a present value. Okay, that makes perfect sense, right? So we're making these promises way, way out in the future, so we need to take a present value. Under the International Financial Reporting Standards, it's the present value of the defined benefit obligation, while under GAAP, it's the present value of the projected benefit obligation. But it's interesting in the reading, there's one sentence that's out of paragraph all by itself, just one sentence, that the authors have decided just to use the same kind of terminology for both present values. It's important that these are measured without subtracting the plan assets, and they require all different sorts of assumptions. We mentioned a couple of those earlier, but let's add things like vesting, and let's add things like estimated future benefits. All right, under U.S. GAAP, present value of the projected benefit obligation. All right, I already said that. So here's, it's the actuarial present value of the assumed discount rate of all future benefits earned to date based on the expected future compensation increases. That's that long quote that I was telling you about in that previous slide. Of course, we need to make this assumption that we've always done about going concerns, right? That the employer, and then of course the plan itself, is going to last for a really, really long time. Going concern, they'll last forever. And under GAAP, there are some other measures of pension liability that are important. The vested benefit obligation. Of course, sometimes an employer says something like, oh, you know what, in order for us to pay you these retirements, you need to work for a week. Probably a little bit longer than that, maybe a year, maybe 2 years. I mean, it could be anything. And then the accumulated benefit obligation is exactly what you might think it is. All right, we need to get some terms here. Current service cost, this is the present value of the benefits earned by employees during the current period. Interest costs, of course, we're deferring these payments, right? So we're going to pay them in 10 or 15 or 50 years from now, right? Depending on the age. And so we need to have an interest cost to reflect the financing cost of those deferred payments. And then past service costs, those are obligations during previous periods. We'll have actuarial gains and losses from gains or losses that are experienced or changes in the actuarial assumptions. We'll see a really good example about a little bit later. And then benefits paid. And so here's our first example. So let's go ahead and get out our financial calculator so we can do some of these calculations quickly. And if you feel like you need to pause the recording, please do so. All right, here we have an employee that's worked for 10 years, right? And is going to retire in 3 years. Compensation is going to increase by 5%. We'll use a 10% discount rate. And the benefit is 2% of the final salary for each year of service. Employee is entitled to past service benefits with immediate investing. And so look at the very bottom. What we're trying to do here, so here's the question on the exam. The pension obligation at the end of the 3rd year is closest to. All right, so let's go ahead and get out our financial calculators. So this is all you need to do here, right? Let's start with the $30,000 current salary and then just multiply by, what was that annual compensation increase? 5%. So just multiply by 1.05, then multiply by 1.05, and that gets us to the 31,500 and the 33,075. Let's go ahead and determine those current year benefits. So you should have 33,075 in your calculator. And so just multiply that by 2%. And so I'll get my calculator out here with me. So 33,075.02 times. So that gets me the 661. So we're going to put that in year 1, 2, and 3. And then we're going to multiply that by 10 years of service, right? So the 661 times 10 in year 1 gets us the 6,615. So notice that we put in red. So the reds are kind of linked mathematically. Then the what is that, purple or blue? The blues are kind of linked mathematically. So then moving to column 2, just take the 661 in red and 6615 in the blue, sum those and you get the 7276, and you do the same thing out in year 3. Now, of course, my academic brain is saying, boy, this would be a lot easier if we just had an Excel spreadsheet. And so my recommendation is to go ahead and put this in an Excel spreadsheet. just so you can see all the math and you can see the changes, because, look at this LOS, explain and calculate measure. So we're doing the explaining as we go through this, and then you're calculating by putting that formula in each cell. And then the cool thing about that is that once you get to the LOS that says something like, hey, what if you change some of the assumptions? Then you can just go back and just change one of the assumptions and it'll calculate it for you. And you can see that, and you can do that multiple times. Oh my gosh, what did we call that before? Back in our economics days, we called that sensitivity analysis, changing one input and see what the resulting output is. All right, so look at that row. What row is that? 1, 2, 3, 4. Total benefits earned. All we're doing is summing the current and the past, right? So we get all the way out to 85.99. All right, so how do we get that opening obligation? So what do you have in your register from what we did before? Let's just clear it and put in 66.15. So put that in your register. And then remember, the interest rate is 10%. So do 1.1 divide, and that gets you 1 year. Then do 1.1 divide again, and that gets you 54.66, and do 1.1 divide again, and that gets us down to the blue, the 46.69. I'm sorry, the 49.69. So let me just review quickly. So you take the past service benefits, and we need to discount them 3 periods, right? Because this is 3 years. So 66.15 divided by 1.1 raised to the third power. Notice in my calculator, I just kept dividing by 1.1. And then you do that again and again for each year 2 and 3. But this time you're just going to raise it to the second and raise it to the first power. So that opening obligation is 49.69. And then the interest costs, this is why we picked 10%. So you can just do the math there quickly. So you have the 10% of 49.69 gives you the 496 as well. And you do that all the way across. Current service cost, then notice that that's in red, so we're going to go all the way up to the top. So let's do 661.5 and then enter 1.1 divide, and then 1.1 divide again, and that ought to get us the 546. So we got 2 years, right? 2 years from year 1 to year 3, so that gets us all the way out to year 3. And then the closing obligation, just sum those 3 numbers, the blue and the black and the red. And that gets you the closing obligation for year 1 and then 2, and then do that in year 3. And so that 85.99, so let me go back to that question here. The pension obligation at the end of the third year is closest to, so there's our answer, 85.99. And then, boy, I didn't warn you about this, but I'll tell you now. Notice that at the bottom right, we have calculations. So if you didn't follow along quickly with your financial calculator, there are the calculations, and then we have another page, another slide of calculations. So I would be prepared to, now let me just go back to my table. I would be prepared, and this is where I think the benefits of using Excel are quite revealed. If you have this in your Excel spreadsheet, then you can go back and you can calculate each one of these, and you can see those right in front of you without having to worry about your calculator and putting it in a table and writing them anywhere. So I would be prepared. This is 3 years. I can't imagine that the CFA Institute would give you this and say, okay, let's do this for 25 years, right? That sounds like a long time. But 2 or 3, maybe 4 years sounds like a reasonable question. I'd be able to fill in each one of those rows for any one of those 2 or 3 or 4 years. So that'll take some practice. But again, with the Excel, you could probably do that way more efficiently. All right, how about a funded status? So fair value of the plan assets minus notice that we're calling it present value of the defined benefit obligation. And that's, of course, what it is. But what do we know? We know that present value and market value and fair value, they all mean the same thing, price, et cetera, et cetera. All right, so fair value minus the present value. So we have a couple of choices, right? Is there ever going to be a scenario under which where fair funded status equals 0? Probably not, right? So we're going to either have a positive funded status, which of course is known as a surplus, or a negative funded status, which is known as, this is probably what all of the defined benefit plans have out there. We'll call that a deficit. Now, one of the interesting things, and I want to skip ahead here. I'm going to go back. So here we have a surplus. So let's take a look at this. So we've got the fair value of the plan assets. So it's over 8,000, right? And so our liability, our obligation is only 5,000. So that looks an awful lot like we have about a $3,000 surplus. But notice in that third row there, we have present value of available future refunds and reductions in future contributions, $2,000. This is kind of like a ceiling. And so we need to take that out. So look at the bottom. We need to report the minimum of the 3,000. What is that number? $3,830, or the ceiling of 2,000. So the net pension asset reported is the $2,000. So this is a great multiple choice exam question where you want to say that we're overfunded by the 3,830, but in reality we have this ceiling. And the reason that this ceiling is in place is not just to complicate our lives for the exam, but to make certain that when investors, in particular shareholders, see this, they don't think, oh my gosh, we have a tremendous surplus. I mean, let's just suppose that this number is super high. Fair value of the plan assets. Suppose in this case it's $1 million instead of 8,000, right? So if a shareholder looks at this and thinks, oh my gosh, look at all these assets, $1 million. How about if we take some of that and, hey, let's pay us a dividend, or let's invest in positive NPV projects? Well, remember that this is not the shareholder's capital. This belongs to the employees. So that's why that ceiling is in there. So make sure that you don't put 3,830 as a choice, because you know 3,830 will be a choice on the exam. Make sure you put 2,000. All right, so I wanted to skip ahead to tell you about the asset ceiling now down there. Present value of future economic benefits. Okay, just remember it as a ceiling. And so then that leads us over to the next one, negative funded status. This is called a deficit. And most pensions are in a deficit status. All right, so there we did our example. All right, how about this LOS? Components of the company's DB pension costs. All right, so total periodic pension costs. So we start with what our current service cost is. We add in interest, we add in actuarial losses, we add in past services, and then we subtract out returns and on the plan assets and any actuarial gains. So notice we have those in black and in red, plus and minus. All right, let's go through a couple of those items there. Current service costs. This is present value of new benefits earned. All right, so fully and immediately recognized as a defined pension expense. I mean, that makes perfect sense, and that's applied under both sets of accounting bodies. But how about the past service costs? So this happens when a plan begins, right, or it is amended. And of course, amendments sometimes can be positive and sometimes they can be negative. Look at the second arrow point. Companies may also set out plan curtailments. That doesn't sound good, right? Do you remember that great Seinfeld episode where they were going to reduce the water flow in the shower heads, and Kramer looks at the guy and says, that doesn't sound good, right? So plan curtailments are going to be something like, they'll tell me, hey, Jim, remember we were going to pay you $100,000 a year, but well, now we're only going to pay you $30,000 a year. All right, so how do we handle this under the international rules? Fully and immediately recognized, and these are, of course, then unamortized. But in U.S., they're recognized in other comprehensive income and requires amortization for those remaining years of service. So notice we put in red bold, unamortized and amortized. So that's probably a really good potential question. Let me just remind you about that OCI, the other comprehensive income. This sounds an awful lot like, oh, it ought to go in the income statement somewhere. But remember that other comprehensive income is income that is other, and it's probably not realized, and it probably should show up somewhere else. And this, of course, is where it shows up over on the balance sheet under equity. And pensions go in there, and typically the other big one is gains and losses in currency transactions. So remember that, other comprehensive income in U.S. GAAP. Now, how about interest costs? Remember that you have interest because we're deferring, right? So it could be a net interest expense, or it could be a net interest income. The math calculation is super easy, right? We're just going to take the discount rate times our net pension liability. That was part of, excuse me, that was part of our simple calculation in our table from before. And remember, we picked a discount rate of 10%, but here, companies are not supposed to just pick an interest rate. They're supposed to say, all right, let's go out and look at something that's in the marketplace. So let's scan the environment. Let's take a look at high quality corporate bonds with, oh boy, I love this word in there, with a duration that's similar to the timing of the company's future pension obligations. I believe we did this back in level 1. I know we'll do it in level 2. And of course, we'll do some wealth management on this topic in level 3. But, what do we call that? I can't help but say this. Immunization, right? We match the obligations of our portfolio with the duration of whatever out there we're funding it with. So duration on the left-hand side, duration on the right-hand side. They have to be identical. And then we'll find out all the challenges with duration matching. All right, under the international rules, net interest is fully and immediately recognized in profit and loss, but under GAAP, the interest expense is recognized. However, what we need to do is make sure that we take the amount recognized as interest income. We need to take that and multiply the plan assets by the expected return on those plan assets. And so the difference there is recognized as a component of other comprehensive income. So remember, the international standards, you just throw it over there, profit and loss. But in GAAP, you take the interest expense, that goes where it ought to go. But then the difference is recognized as a component of OCI. How about remeasurement? So of course, over time, we're going to have actuarial gains and losses because we're going to change actuarial assumptions, right? If we did this back in 1981, when interest rates were super high, 20%, right? Well, they don't apply in, let me just pick another year. Let's say 2015, when interest rates might have been 0. So we have to change our actuarial assumptions. And so that's going to lead to difference between actual returns and expected returns on the plan assets. And so notice, once again, the international rules fully and immediately recognized. These are not amortized. Under GAAP, they are immediately recognized in the P&L, or they can be thrown over to other comprehensive income. But under US GAAP, we can amortize these under the corridor approach. Remember, if we have an increase or a decrease in plan assets by something greater than, let's say, 10%, we don't really want to tell the shareholders that we've increased this. What did I say earlier? $1 million or $1 billion or $1 trillion. And so we amortize those. That should make sense. Here's a slide about plan assumptions. So turnover, length of service, discount rate, futures, right, rate of increase, retirement age. And there's a fun one, mortality. I always tell my students that you need to pay attention. You need to go ahead and study for the CFA exams and become a pension fund manager, because the advantage of it is that somebody throws you money every day. They say, here's our money, do something with it. And by the way, you'll owe us money in 40 years. I mean, that's a great job, right? However, it comes with a lot of stress. And I tell my students that as a pension fund manager, you walk around and ask the employees every day, how are you feeling? Are you feeling okay? Are you sick? Do you have health insurance? Do you have life insurance? Are you going to retire anytime soon? How long do you plan on living? So, there's marginal costs and marginal benefits. And so the mortality assumption, of course, that'll just be given to you on the exam. But the reality of life is that you're dealing with individuals and humans, right? All right. How about this LOS? Explain and calculate the effect of defined benefit plans assumptions. All right, so discount rate. We need a discount rate to compute present value, right? We need a discount rate. We're going to find one, high quality corporate bonds. It affects both the pension obligation and the periodic pension expense. And so I think a great question is, hey, what happens when interest rates go up? What happens when interest rates go down? And so you ought to be able to know exactly what that impact of a changing discount rate is. And we have a slide here in just a second. Average annual growth rate. Of course, this is going to have an impact on both the obligation and the expense, right? It's going to increase salary increases and increase the pension costs. I mean, that makes perfect sense, and the obligation. How about the expected growth in plan assets? No effect on the obligation, but it's going to reduce the periodic pension costs. That makes sense. All right, how about a higher discount rate? Decreases the current service cost, decreases the interest cost when the time to retirement is long, and it increases it when the plan is mature. Has no effect on the expected return on plan assets. That makes sense. And it will decrease the pension expense. Higher rate of compensation growth. Yeah, this sounds to me like this is going to increase everything, except it's not going to have any effect on the plan assets. Higher expected return on the plan assets. This sounds like it'll increase, of course, the expected return. It'll probably decrease the pension expense, but it's not going to impact either the current service costs or the interest cost. Here are a couple of tips. Fund can improve its reported financial performance, right? Remember now, the fund gets to pick these things, and you can't pick at the extreme, but you can have some leeway. There's a narrow range, so it can improve its financial performance by increasing the discount rate, lowering the compensation growth rate, and increasing the expected return on plan assets. You know what I love about those colors there, the purple and the orange and the blue, is that these sound like great questions inside of the vignette. I say this to you regularly, and I think it's worth repeating again. You're going to get a bunch of paragraphs in there, and there are going to be some statements, and someone's going to say, there's going to be an analyst, let's say Lewis, and Lewis says, hey, lowering the compensation growth rate is going to improve the reported financial performance. And then down question 4 is going to be, do you agree or disagree with what Lewis said in comment 1 or comment 2? So I think those are really good. The following will increase the pension plan obligation. Okay, right, lower discount rates. All right, so these make perfect sense. We've done that before. So let's work through an example. A DB plan that has just been established. All right, so here's an employee, $30,000, first year of employment, is going to retire in 3 years, 5% salary increase, and here we go. Will receive a benefit for 15 years, 2%, discount rate 10%. So here are the 2 questions. What is the pension obligation for each of the 3 years? And then part 2, what happens if we change, look at that, what was that last orange arrow point, discount rate of 10. What if we change that to 8%? So here's going back to our Excel spreadsheet. You can just substitute 8 for 10 and hit the enter button, and you'll get all of these answers. All right, so do we want to have our calculator handy like we did before? Final salary, that's the same calculation that we did before. So that gets us out to $33,075. Annual benefit, let's look at the little illustration at the bottom. So there's today, we're working for 3 years, and then we're retiring for 3 years. So that annual benefit is the salary, $33,075 times 3 years of working times the 2%. Where are we there? Look at the second to last arrow point, benefit based on 2% of the salary. And so years to retirement is 3. So we're taking the 2% times 3 times the 33,075. So there's a good calculation there, right? 1984.50. All right, let's go ahead and solve for the closing obligation in years 1, 2, and 3. So what did we just calculate on that previous slide, right? There's the annual benefit, the 1984. So let's go ahead and compute the present value of that. And if you look, there's that annuity formula, and you get the 15,094, but I'm guessing that you probably don't want to use that formula. So let's do this. Ready? Get out your financial calculator. Let's do 1984.5. Let's make that payment. Let's make 0 future value. Let's make 10I. Let's make 15N. Let's solve for present value. And that ought to get us our 15,094, of course. I'm pretty sure that's the way you'll do it on the exam with your financial calculator. And then just hit 3 divide, right? So you get the 5031. So what are we doing with that 5031? So that is going to be our current year benefits, right? So let's go down and fill out the table. So estimated salary, there's the 30, right? Then 5% more is 31,500. 5% more, there's the 33,075. So current year benefits, we just computed that. There's the 5031. And we do that for year 2 and year 3. And then the row above it, prior year benefits. So then we're just adding, so we get those. All right. All right, then notice that the total benefits earned, so this is the important row here. So let's sum current and prior. So notice that in column 1, we put that 5031 in red, and then we put the 10,062 in green, and then the 15,094, that's in black. All right, so total benefits earned, 5,000, 10,000, and 15,000. So we knew they were going to be around those numbers, right? All right, so let's go ahead and figure out what that opening obligation is. So notice that I have the total benefits earned, the 5031 in red, and then the 4158 in red. So let's go ahead and link those in red. So you ready? Put this in your calculator, 5031.42, hit enter, and then do 1.1 divide. There's our interest rate, and there's our, and then do 1.1 divide again, because 2 years, right? So there's the 4158. All right, so you should be caught up. And then let's go ahead and put our 10,062, whoops, 10,062.84, and then just do 1.1 divide. So that gives us our 9148. So there's the linkage between those two in the green. And then our opening obligation in red, 4158. Let's multiply that by 10% to get the 415. Let's take the green 9148, multiply that by 10%, and so we get the 914. And then to get the current service costs, all we need to do is let's do 5031.42, enter, 1.1 divide, and that gets us 54, 1.1 divide, that gets us to the 4158. And so you do that 3 times, right? And then the purple, just sum the opening obligation, the interest cost, and the current service cost, and that gets you the row of closing obligations. So let me just swing back here. So our first question was pension obligation for each of the 3 years. And there it is in purple, 4158, 9148, and 15094. Feel free to take my earlier advice and put this into an Excel spreadsheet, and you'll be able to see the exact math. And then let me go back here. What was our part B? What happens if we decrease the discount rate to 8%? Well, then you have that table, and you can just go ahead and change it to 8%, and all of these numbers will go ahead and show up in your Excel spreadsheet. All right, so look at the solution at the top. Decreasing the discount rate to 8% increases the year 2 closing obligation to $10,458. What was it just on our previous slide? It was $91.48. So now it's $10,485, and it changes the current service cost to $52.42. And what was it there? It was $45.74. And there are the calculations that are shown. So if you need to go back and do those, go ahead and just pause the video and go ahead and recalculate those. But of course, if you've done it in Excel, you have all of these answers right in front of you. All right, how about adjusting for pension and some other post-employment benefits? All right, companies have to disclose assumptions relating to discount rate, salary, expected return on plan assets. And so this is what I was saying just a little bit earlier. Look, these can be conservative or aggressive, and these can have biases in them. And it's probably a function of the personality of the pension fund manager. If that individual is conservative, and it's probably a group of individuals as well, then that's probably going to be the bias. If they're aggressive, then that's going to be probably going to reflect the bias, which brings in a really challenge to us as financial analysts. How are we going to make adjustments to counteract those biases to get a true value of all of these output variables that we're discussing? All right, of course, discount rates are going to differ across companies due to, right, they're in different geographies, they're in different parts of the world, there are different market rates of return, there are different ways to value bonds, et cetera, et cetera. And then, of course, probably there are differences in the timing of the obligations, especially if you have a young workforce versus a workforce that is nearing retirement. The assumptions, of course, should be internally consistent. This goes all the way back to things that we've talked about back in ethics, right? If you have a discount rate over here, you ought to have a discount rate over here, and they should be consistent with each other. All right, how about the difference between gross and net reporting? Companies recognize the amounts on the balance sheets as net amounts. But if we're going to, as good financial analysts, adjust these, we should probably go back to the gross amounts because they're going to impact lots and lots of ratios, but mostly return on assets and leverage ratios. Actuarial gains and losses and past service costs are treated separately under GAAP and the international standards, and so the analyst has to adjust them for comparison purposes. This goes back to what we talk about in all of these series of readings, is that when there's a difference between IFRS and GAAP, then we need to make those adjustments to make sure that we're comparing apples and apples. All right, how about periodic pension costs? A company reports all of the components of pension costs on the income statement as operating expenses, right? That makes sense. However, some of those periodic pension costs are recognized in various lines under the international standards. And so here's a good lesson. Let's go ahead and do this. Report current service cost, report the interest expense, and then report the actual return. And so those 3 diamond points there at the bottom. Those are really good adjustments to make. Let's go ahead and take a look at an example. So on the left-hand side, we've got, some kind of an income statement here. And then on the right-hand side, we have current service costs, interest costs, and expected return on assets. So there's the net 1,000, actual return on assets. So look at the bottom there. Let's adjust the individual line items on the company's income statement to reclassify. And so this is what we do in this table. So the first 2 columns, those are the same things as what we had back here, right? There's the income before tax, 33,850. And so here are the adjustments. So we need to adjust the operating profits. So let's take out, let's go back here. So we got the 10,050. So there's the net operating expenses. And what we need to do is add back in the 1,000, subtract out the 4,500. So add back in the 1,000 of total, subtract out that current service cost. So that gets us to an adjusted amount over there, and that changes the operating profit, obviously. And then we need to add that interest expense in. That gets us up to 76. Oh, excuse me. Those of you who watch lots of my recordings will notice that I use the James Bond technique. I couldn't use it there. If you take your knuckle and put it up under your nose, that will get rid of a sneeze. That one came on so fast because of my allergies. So please forgive me for interrupting. But feel free to thank me for giving you that little trick. Next time you're on a secret mission and you can't be spotted by the enemy in a James Bond movie, just do that. All right, so forget about the James Bond stuff right there. So that leaves us with, well, what did we used to have? We had 33,850. Now we have an adjusted income before tax of 26,300. That sounds to me an awful lot like, look at the LOS, explain and calculate. And so this is, look, this can show up very easily in a vignette, those 2 tables. How about the LOS on cash flow disclosures and maybe some other ones here? Pension plan disclosures are used to analyze a company's pension and other. Yes, of course, that makes perfect sense. All right, so cash flow impact is the amount of contributions that the company makes to fund the plan, right? So if we have a deficit, even if we have a surplus, but especially if we have a deficit, we're going to be looking for the company to send some cash our way as the good pension fund manager. So the impact is going to depend on what the laws and the regulations are in each particular country. So let me read some of these to you here. Company may choose to contribute in excess of the regulations requirements. Let me scratch my head on that one. Pension obligation decreases when the sponsoring company's periodic contributions exceed the total pension costs for that period. That makes sense. Contributions more than the total pension cost is similar to a loan repayment. I love that analogy. Source of financing, of course. And so look at that bottom circle point. Analysts may choose to adjust the cash flows where the amounts of benefit obligations are material. So let's go ahead and look at a quick example here. So here's a table. We've got 237 of pension costs, but we have 300 in the company's obligations. So there's some cash flows from operating and financing and tax rate of 30%. So here's the question again, adjust, right? So let's make the adjustment, but now we're going to reclassify between the operating and the non-operating items. So here's the quick math, and I'm guessing that you guys should see this. So we start with the 300. There's our pension 237. Take the difference, 63, multiply that by the tax rate, and that gets us down to an after-tax contribution of 44 after tax, so that's important. And so notice on the right-hand column, the cash outflows from financing increased by 44. Cash inflow from operations would increase by 44. So they offset each other, right? That makes sense. All right, let's get into the final learning outcome statements. So share-based compensation. So of course, instead of paying the employees in terms of cash, they can say, you know what? In addition to cash, we're going to pay you with some shares. So that's what share-based compensation is. It can take lots of forms. It can be in actual shares of stock, common or preferred, right? It could take the form of an option or phantom shares or stock appreciation rights. So what we need to do is make sure that we report these as fair value. Here's a good question. Why share-based compensation? I talk about this all the time in my corporate finance classes, that if you give an executive an option that says something like, hey, our stock price here is 100. We'll give you an option with an exercise price of 200 and we'll let it last for 7 years. Then that executive has extra motivation to find positive NPV projects to increase the stock price over that $200 exercise price, so that the options then have some intrinsic and time value for the executive. So what does this say? Motivates employees beyond their regular cash-based salaries. And there we go. Oh my gosh, remember that agency conflict where the executives are kind of motivated to act in their own self-interest, but this aligns the interest with those of shareholders. Now, of course, this sounds perfect in theory. Sometimes it works, other times it doesn't. There's tons of academic research out there that says, hey, when executives are awarded stock options, stock price goes up. Some show that stock price really doesn't care much, but there are some other factors. We can talk about that some other day. Advantages: no current period cash outlays, aligns the interests, takes different forms, right? They can be equity settled or cash settled, but it creates an incentive for the employee to stay in the company for longer time periods. Now, of course, you want to, as a board of directors, you want to award and grant the executives who you want to stay around in the company for longer. Now, look up at the advantage. Requires no current period cash outlays, right? However, it shows up as an expense on the income statement. So it reduces earnings and it dilutes earnings per share. And so the analyst has to make an adjustment, and it's really a simple adjustment. Just go ahead and add that expense back because, and then you have to consider the tax advantage as well. It's a little bit like depreciation expense. Look at that third arrow point. This is what I was saying about a disadvantage. Does not necessarily provide the desired incentive, limited influence over the company, unless, of course, it's the CEO. Now, I would love to talk to you about this last arrow point. Skewed payouts that reward excessive risk taking may drive managers to seek more risky projects, and that is a true statement. However, shareholders might want the executives to take more risk. You might remember the example that I have given before. Milton Hershey wakes up every day and he makes chocolate bars and Hershey Kisses, right? That's low risk. Well, the Hershey shareholders, they might say, you know what? We're tired of buying at 100 and selling at 108. We're tired of an 8% return because this is a branded, mature product line. We want you to do something else. Make golf clubs or get into computer software. I mean, those are extreme examples, and I'm guessing Milton Hershey probably is not going to do those. But that's why when you go to the Milton Hershey webpage, there are thousands of different candies out there. They're trying to take risks. So my point here, and this probably has nothing to do with at least this part of the LOS, is that sometimes shareholders want more risk. All right, of course, U.S. and international standards require disclosures, nature and extent, how the fair value and the effect on companies' income. I mean, that makes perfect sense. Does not require any cash. However, there is going to be some kind of an economic impact because when the executives exercise their option, this is going to increase the number of outstanding shares. And of course, there are two ways there that you can make those adjustments. Stock grants, either outright with restrictions or contingent on performance. All right, that makes sense. outright stock grants. So these are awarded to employees outright with no conditions. They're reported at fair value and the shares are fully invested. Restricted is that sometimes the shares have to be returned if they don't meet certain conditions. And those conditions can be specifically employee-based or firm-wide based. But of course, they're still reported as fair value. Contingent stock grants, they're only granted after the employee meets specific targets. All right, stock options, certain number of stock options at a set price. Both the international and US GAAP require reported at options fair value. Oh, I've been waiting for this for the entire slide deck. Valuation model, look at this. The Black-Scholes-Merton option pricing model and the binomial model. These are popular valuation models. I can't wait to tell you about these models. They're so much fun and they're relatively easy to understand. Those will be really super fun calculations. Here are the variables that you need to compute the fair value of an option using the Black-Scholes-Merton model and also the binomial model. You need the exercise price, you need stock price, volatility. That's the standard, usually the standard deviation of the underlying shares, estimated life. And this is the big difference between like just valuing a regular old call option on a share of stock, because those things expire typically in the short term. But these executive stock options, they expire. They have expiration dates of 5 years, maybe even 7 years. We need a risk-free rate of interest, and we need a dividend yield. So here's a really good, notice this is a shaded block. We put that in. So inputs that increase the estimated fair value. I would remember this. Higher standard deviation, absolutely. Longer life, absolutely. Higher risk-free rate, absolutely. Stock appreciation rights. These are based on an increase in the company's share price. Of course, they're reflected at fair value. But this compensation expense, this is allocated over that service period and has to show up on the income statement. Phantom shares, this is used for private companies that don't have shares of stock that are trading, and so they try to replicate it. So a hypothetical stock. That makes sense. I mean, this is a fascinating model to be able to use. I mean, this has nothing to do with the LOS, but this just begs the Monte Carlo simulation to be used. And that was a long slide deck. It's a long reading. Hopefully I gave you the breadth and the depth. We did some financial calculator stuff, so you should be ready for all of these questions.